The danger is in the drywall. China's property debt is clogging the credit pipes that move money between builders, banks, and households. When those pipes constrict, credit rations, borrowing costs rise, and risk appetite flips across borders. Pause for a coffee. This one's strong. Think of this as a yard sale in the middle of a fire. Rewind to just days ago. Evergrande's court-appointed liquidators hired UBS and Citic to sell a $1 billion property services unit. It sounds technical, but this is where fire meets sale. That offloading isn't at face value. It's at distress value, meaning buyers only step in at fire sale discounts. When that sale clears low, expect a ripple. Banks write down collateral, credit tightens, and cash flow, what we call liquidity, drains out of the system. Credit hasn't just slowed, it's gone into reverse. July's data just red-flagged a turning point. New yuan loans shrank by roughly 50 billion yen, the first monthly contraction in nearly 20 years. That's not just a slowdown, it's the financial engine running backward, money creation turning negative while activity keeps moving. Lending, not saving, keeps economies moving. With that gone, the machinery starts seizing. The economy's growth engine just coughed. Factories are easing off the throttle, and storefronts are quieter than they've been in months. Assembly lines are still moving, but with shorter shifts and fewer overtime calls. Shoppers are browsing more than buying, and discount tags are creeping back onto windows. Big build-outs and equipment upgrades are being deferred, not green-lit. Confidence softens, households hold back a little longer, and the machine drops down a gear. Ports don't lie, and right now they're whispering softness. Trade signals flickered red too. Chinese port activity, a high-frequency barometer, slipped further through early August. Less demand, less credit, and less liquidity, those arteries that keep global trade moving. Cutting rates won't do it. Confidence can't be forced. You might ask, why not just cut rates? Because when firms and households retreat, a lower interest rate is a whisper in an empty room. Lending contracted despite cheaper credit. That's the trap of a balance sheet recession, when everyone is too busy repairing their own finances to borrow, no matter how low rates go. When China sneezes, your invoices feel it. This isn't confined to Shanghai. Global plumbing connects through trade, credit, and sentiment. When their liquidity dries, global supply chains feel it. The weak link isn't Wall Street's giants, it's American regional banks. These regional banks hold a disproportionate share of commercial real estate exposure. They're not bulletproof. Regulators have already flagged smaller banks' vulnerability to CRE downturns and mark-to-market shocks. That's when assets suddenly get repriced to ugly current values instead of cozy book numbers. It doesn't take a U.S. crash, just contagion via tightened dollar funding, shifting valuations, or sentiment shock. Big banks may look solid, but the cracks show up elsewhere. Sure, the giants pass their stress tests, even with real estate shocks baked in. That matters, but trouble rarely starts with the strongest players. It seeps in through the smaller banks, through the ways they borrow in big chunks from markets instead of depositors, and through lenders quietly pulling back when they get nervous. Smooth charts can hide rough waters underneath. On the surface, prices and statements can look calm. But private assets, things like smaller developer loans or distressed projects, take longer to show the hit. That delay creates the illusion of stability while pressure is quietly building. And when the break finally comes, it's the latecomers who get burned. If Evergrande's assets sell at rock-bottom prices, it means banks everywhere will have to admit losses. If shipping containers keep stacking up at ports instead of moving out, demand is shrinking. And if smaller U.S. banks start tightening loans on offices and malls, that's a clear sign the stress has jumped across the ocean. This isn't panic. It's about not getting blindsided. Hold more cash than you normally would so you can move when others are stuck. Don't load up on debts that all come due at once. Spread them out so you're never cornered. Stick with firms that keep plenty of cash on hand and whose numbers match reality, not wishful thinking. And ease back on industries that swing hardest with China, like shipping, metals, and heavy construction. Skip the math. Watch the signals. Evergrande is unloading assets at fire sale levels. Banks are pulling back instead of lending, and developers are struggling to sell homes. Factories are easing output. Stores are seeing fewer buyers, and ports are handling lighter traffic. Put it all together, and the picture is clear. Momentum is fading, and demand is softening. Local governments depended on selling land to raise cash. Now prices are falling and the money isn't there. Families who park savings in property-linked products want their money back, forcing sales that put more pressure on banks. Developers and cities also owe a mountain of dollar debt coming due soon, and if the currency slips, rolling those loans gets a lot tougher. That leaves China's central bank stuck. Defend the currency or keep money flowing at home, but it can't do both. And stress never stays hidden for long. You'll see it in slower trade, tighter lending, and eventually in global markets too. Window dressing won't fix the plumbing. Policy lifelines alone won't rescue the system. Only transparent restructurings, separating viable developers from zombies, can reset confidence faster. Without it, expect drawn-out, slow-motion liquidity erosion. Rip the Band-Aid or let it rot. Done right, Beijing rips off the Band-Aid, lets fire sales reset valuations, and clears space for healthy credit to return. Investors take the pain up front, but confidence comes back quicker. Ports refill, and global trade finds a floor. Done sloppy, policymakers drag their feet, extend and pretend, and liquidity evaporates anyway. Asset sales trickle out at discounts. Banks hide losses until they can't. Contagion spreads across borders, and U.S. commercial real estate cracks wide open. Forced sellers get wrecked. Households lose faith, and trust in the financial plumbing corrodes. This starts in real estate, but it doesn't stop there. Bottom line, this isn't an abstract property crisis. It's a liquidity event that begins in real estate, runs through credit, and spills into global funding and sentiment. It won't stay in Beijing. It can stress test American shores. If you want straight, no fluff breakdowns when rules shift and markets re-rate, hit subscribe and ring the bell. Guard the coffee. Guard the edge. Context beats clickbait. Always. History rhymes. Power rebrands. Stay inquisitive.